24 seconds away from the opening bow this morning. Good morning to you. Equity futures lower by 1/3 of 1% on the S&P. On the Nasdaq down 3/4 of 1%. On the S&P heading towards the biggest weekly loss of the year so far. On the Nasdaq 100 heading towards the first weekly loss of the year so far. Futures a bit softer. There's your opening bow. Switch at the board and get to the bond market. Yields near the highs of the year. Just sub 370 on a 10-year. 368.26. Yields up 2 basis points on a 2-year through 450. We closed out 2022 at 442 and right now 447, but this morning through 450 going into CPI on Tuesday. In the FX market, euro dollar negative 0.4 of 1%, back to 106, 107 right now at 106.98. And that crude rally, it fades just a little bit. Been pretty powerful through the week, still up by 7 to 8% or so on WTI, just short of 80, $78 and about 90 cents at 1% on the session. About 30 seconds into this session, we're down 0.2 of 1% on the S&P. On the Nasdaq, we're down 5 or 6/10 of 1%. One stock to watch at the open. Check out Lyft, flirting with its biggest one-day decline on record after issuing disappointing guidance. The CEO, Logan Green, saying the following: the company is reviewing adjustments to the business, including cost-cutting measures. Mandeep Singh, we're down 31%. And Mandeep, I have to say, you flagged it a little bit earlier this week.
Yeah, and look, I think the fact that CEO is talking about cost cutting when your competitor is growing north of 35%, it's not a good sign that they're focused on, cash burn right now. And Uber specifically talked about their incremental margins being 12%. In the case of Lyft, they're negative. So what it tells you is even though they grew in the quarter, they had all sorts of problem on the cost side, whether it was insurance or just adding driver supply, and that's not a good healthy marketplace. So clearly scale is an issue for Lyft, and right now they are too focused on cost cutting when your competitor is taking market share.
Mandeep, why are their fates so different right now? What does Uber have that Lyft doesn't?
So Lyft has more of a West Coast exposure, and they talked about, West Coast being slow to come back in terms of reopenings and just the volume of rides. I do think they didn't focus as much on the supply aspect that Uber got it right, and Uber was somewhat helped by bundling delivery. So right now, think of, how many subscriptions a customer can have. You can have an Uber subscription, DoorDash, Lyft. You can't have all of those. And what Uber did was they bundled everything, and if you had to pick one, chances are consumers are going to go with an Uber subscription as opposed to the others that are offering, and that is where scale matters. I think that's the only mode in this business is scale.
Mandeep, is it too early to say there will only be one winner here in the US and there just isn't space for two?
I mean, it was a duopoly, but the duopoly wasn't even. And I do think Uber is gaining at least 1 to 2 percentage points of market share every quarter. So right now it was 70-30. I think in the next few quarters it'll probably be 80-20 if I had to take a guess, and that will force Lyft to consider strategic options.
What are those strategic options? A sale. Well, talk to me about it. Who would be the buyer?
Well, it could be any of the large tech companies that is trying to play the autonomous theme. So Lyft still has a network where you could deploy those cars. And I think that's where it gets interesting, because you need the data in terms of how the routes are, what sort of demand there is. And to my mind, whether it's level 3, 4, or 5, if you are trying to play the theme of autonomous as a car maker, you have to think about how to deploy it. And the ride-sharing companies are perfect for that. So Lyft still has a network that is valuable for any car company trying to deploy autonomous driving.
What a move. Mandeep, great work this week. Appreciate it, sir. As always, Mandeep Singh there of Bloomberg Intelligence. Look at the name, Lyft, getting hammered, down 33%. Close here, biggest one-day decline ever. Frame it this way, though. Close the year 2022 at 11. Right now, 10.84. We'd rallied by more than 40% year to date. We've wiped it all out, just like that, in 3 or 4 minutes. Brutal stuff for that stock. Bit of a mixed picture for PayPal. Let's pick up on that company. The company reporting better than expected guidance on the back of a slow growth quarter. Ed on the West Coast with more. Hey, Ed.
Yeah, good morning, Jonathan. Happy Friday. The market, as you say, is kind of weighing both negatives and positives. The negatives are that payments volumes did drop faster than expected in the holiday quarter, slowed down faster than expected. So the top line picture is murky, and they didn't give full year guidance on the top line. But cost cutting seems to be working, and the market, at least this Friday, cheering the EPS guidance that this year earnings per share will climb to $4 $4.87, 18% gain. I think the street was looking for something like $4.75 for the full year period. Dan Schulman, longtime CEO, will retire at the end of this year, so that is another factor. This is a stock that a year ago was trading at $120 a share, but the other way of looking at it is its valuation relative to major benchmarks, how attractive it is. It's interesting because you can take two inferences from it, right, John? You can say, okay, gross payments on the platform are really slowing down. That's a worrying sign in a holiday quarter for the consumer, but there's still growth there, even if it's slowing. It's just we didn't get a firmer guide on the top line. One important development this morning, John, we've had a regulatory filing this morning that has disclosed a probe. The Consumer Financial Protection Bureau has asked PayPal for information on how it treats customers who have accidentally sent a Venmo payment to someone that they didn't mean to. I don't know if you're a Venmo user. This is something that I've experienced, but kind of a PSA for anyone out there that uses Venmo. The regulators are looking into this.
Someone sent me money on accident once. Not a big number, something like $15, $20.
Tom
and
Keane.
They took it back pretty quickly. Now, TK never sends me money, Ed, never. Ed, can I finish on this? Important question.
Sure.
For you and I both. Is it Adidas for you or Adidas?
Adidas.
Still Adidas?
Yeah.
Do you remember when we were kids and we called Nike in the UK?
Nike. Yeah.
Yeah, that doesn't work here at all. Ed, thank you.
Brits in the US, yeah.
On the West Coast, Ed Ludlow. Adidas. Should we talk about Adidas? Let's do that right now. The stock under pressure, getting hammered in Germany, as the company warns of a 700 million euro loss from its fallout with rapper Kanye West. Ollie Crook out of Berlin joins us now with more. Hey, Ollie.
John, it's remarkable the impact that a single partnership can have on a company the size of Adidas. You know, we knew it was going to be bad going into this, but the price action this morning just tells you that we did not know how bad it was going to be. So Adidas was as recently as, before October when they had to dissolve the relationship, calling this the most successful partnership in the industry's history. It's saying it's going to cost them 1.2 billion euros in revenue this year. And that's an even bigger problem for profit. These are high margin items, the Yeezy line. According to some analysts, it accounts for about half of Adidas's total profit. And these relationships really are the magic for companies like Adidas. You know, they have other partnerships like the Ivy Park brand with Beyonce, but the Wall Street Journal overnight saying that sales from that brand fell 50% last year. So even with someone like Beyonce, it's no guarantee, and it's a story being told in the stock today, but it's also a story being told longer term, Nike versus Adidas. At the beginning of the pandemic, there was a $60 billion market cap spread between these two companies. This morning, it's $160 billion.
You notice how Ollie uses both pronunciations? Because he came from Brooklyn and went to Berlin. So now he's doing both Adidas and Adidas. Ollie,
I'm hedged.
You're hedged, you're going to pick one?
I have to go Adidas. It is correct, I'm afraid to say.
That's the correct way of doing it, because you're in Berlin now. Ollie, thank you. Good to catch up, mate. As always, Ollie Crook there out of Berlin on the latest with Adidas. I live here and I just don't care enough to say Adidas all the time. We need to talk about layoffs too. News Corp, Lionsgate, Canopy Growth. Abby, it's just been name after name after name again this week.
It really has been, and this is really the theme of this year, layoffs, primarily in tech, but now it is starting to spread out a little bit. Relative to some of those big tech names, though, we're talking about the biggest of them, Salesforce, Alphabet, Amazon, Microsoft, Dell. Microsoft layoffs have already begun, actually, starting just yesterday. In total, 10,000 jobs are to be cut. They're offering very generous severance packages. Now, probably the jobs yesterday having to do with an Army goggles contract that was reduced. But News Corp and Canopy Growth, to your point, big layoffs. Canopy is laying off 60% of its workforce, or 800 jobs. It has everything to do with the bad quarter. Both of these companies put up bad quarters, with EBITDA sliding by 30%, sales sliding. So this is probably less a matter of the over-hiring that we've seen so much for technology, and more having to do with fundamental demand. Now, that has been a theme for technology, too. But interestingly, John, we have this divide where we have all these layoffs in technology, 100,000 jobs cut in the tech sector this year, yet the NASDAQ 100 on the year up about 15%. A piece of this may have to do with previous cycles. You have these layoffs, and the bad news is seen as good news in terms of the worst is over. Yeah. But we do have the possibility of some sort of a recession, maybe a rolling recession, and if we start to see these layoffs continue to spread into other sectors, John, it could be a problem.
That's the big if. Avi, thank you for that. Thank you very much. That's the disconnect, for some of you at least. One industry, does it spread? And ultimately, when does it start to show up in the overall numbers? Jobless claims just starting to clip higher this week for the first time, I think, in about 6 weeks, but claims still sub 200k. This is the message from David Kelly at JP Morgan. The resilient growth story won't last long. He writes the following: despite recent strong numbers on GDP and jobs, there is a slowdown lurking which should belatedly cause the Fed to reverse course. It could benefit investors who are willing to position themselves today for an eventful return to a slow growth, low inflation and low interest rate economy. David, I'm pleased to say, joined us right now. David, great to catch up, sir, as always. So let's start there. There's a growth slowdown lurking. Not many of us can see it. What do you see?
Well, I think both the GDP data and the employment data are very distorted right now. So first of all, on the GDP side, we saw a big run up in inventories in the fourth quarter. I still think the trend growth rate of the economy right now is running probably less than 1% in the first half of this year. And the problem is that's going to keep going over at least the next 2 years. We've got a very tight labor market, so we don't have any extra workers to throw at the economy. Productivity growth isn't that strong on a trend basis. So the economy is going to grow very slowly anyway, and the fourth quarter was something of an anomaly. And same thing with employment. I mean, remember, not seasonally adjusted, employment fell by 2.5 million people in January. Now, if you've got a very tight labor market, and this is the one time that you can actually hire somebody who just got laid off, or maybe you hire them. And equally, if you've had a really hard time finding people, maybe you don't lay them off. So I think the fact that January is always so weak in terms of employment kind of distorts these numbers. So I'm suspicious of that. What I see in the economy, though, is a lot of drag, which is going to keep this economy very slow and on the edge of recession if it doesn't fall into recession for the next 2 years.
David, this quote, slow growth, low inflation, low interest rate economy, is this 2019 again? Is that what you're looking for?
Yeah, I mean, we've been on this huge roller coaster, but the interesting thing about roller coasters is you actually get off where you got on. And I think that's exactly where we're going to end up. I think we're going to end up back in the middle of the last decade with the inflation rate going down below 2% in 2024. And in the middle of this decade, the Federal Reserve is going to be muttering about how they can get inflation back up to 2%. This economy is not an inflation-prone economy. And if we just wait for this thing to work its way through, I think we'll be back in a very slow growth, low inflation environment.
So, David, I know a ton of people who take the other side of this who think we have serious regime change on our hands, which means serious leadership change in the equity market. Do you take the other side of that debate as well?
Well, I think that the change in leadership that we've seen in the last year is long overdue. I think that there was an exuberance about markets in a very low interest rate environment, which caused growth to outperform value. And now we've seen that gap close. I think we would see some more closing of that gap in volatile markets, but the gap's not as large as it was. So overall, within the U.S., I think things will be pretty close between value and growth between small and large. The one obvious discrepancy still is the dollar is way too high. And we saw the dollar fall, and now it's reversed a little bit on these strong economic numbers. But I think that long-term decline will resume over the next year or two. So I think that's one part of leadership we still have to see change here, because the U.S. is still, has beaten international equities for so many years. I think we do still need to see some reversal in the dollar, decline in the dollar in the long run, and international equities do better relative to U.S. equities.
David, can we get your world without a contraction in consumer spending, which has been supported for so long now?
Well, you can't get into a recession, I don't think, without a contraction in consumer spending. But remember, consumer spending is 2/3 of the story. But housing is is obviously very weak. You've got net exports are going to be weak because of the high dollar and relatively slow overseas growth. And then government spending, certainly from the federal government, is going to be pretty constrained. So I think you can get a slow growth environment. But you're right. If consumers don't actually go negative, I think you avoid a recession. But there's not a lot powering consumer spending growth going forward. Remember, the saving rate is half what it was a year ago. So people have been racking up credit card debt, trying to maintain a standard of living, which they're not going to be able to maintain. And so I think consumer spending growth will be very slow from here, although it may not turn negative.
Sounds like you're pretty constructive on the bond market. Michael Hartnett of BofA put out a note this morning. He said 60-40, that portfolio, best start to any year since 1991. David, you might appreciate this quote. He said, an English strategist moved back to London with his wife from New York. After 3 years, someone asked the wife, what's the best thing about living in London? And the wife replied, Paris. That's his quote, not mine. I love London. Went on to say, what's the best thing about stocks in 2023? And he said bonds. Now, David, I just wonder how supportive you think bonds are going to be this year.
I think it should be a good year for both stocks and bonds. But if you're a long-term investor, I think you will get better returns out of the stock market longer term. So I wouldn't. It is true that last year was a bad year for bonds after many, many, many good years for bonds. And I think that that we saw that 1 year reversal. I think bonds will do well today. I think people this year. I think by the end of the year, people will recognise that the Federal Reserve cannot sustain a federal funds rate above 5% for long. They're going to start pricing in cuts to that federal funds rate, and I think that'll help the bond market. But still, in terms, given where we're starting in rates, I think that over the next 5 years, you'll make more money in stocks.
David, I just want to finish with one more question on stocks, if I can, and that's on Europe. David, I heard you do a podcast recently with Meb Faber. I thought it was fantastic, and you talked about Europe, and you said the one thing that would change investor attitudes is performance. We're getting that performance, David Kelly. Why do you think it continues?
Well, first of all, I think the European economy has actually gotten through this energy crisis very well. I think the Eurozone economy is doing better actually post Brexit in relative terms than it did before that. So I think Europe has got quite a lot of upside here. But the real issue is, the US is about 60% of global stock market capitalization, but it's also about 60% of global stock market investors. We are the world's stock market investors here in the United States, and we've got to feel better about Europe, for European stocks to outperform, for global investors to put money into Europe. So I think part of it's about European stocks outperforming for a little while, but a lot of that is also about the dollar. If the dollar comes down, that's going to cause European stocks to outperform for US investors. If that continues for a year or two, then I think a lot of people are going to jump on the bandwagon.
David, brilliant to hear from you. Something very self-fulfilling about all of that. David Kelly there of JP Morgan. David, thank you. Equities right now, about 16 minutes into the session, down 0.2%. One story we still haven't discussed this morning. Up next, a new candidate emerging for the BOJ.
Ueda-san is an academic. He's not political. He's very pragmatic. And he says what he sees.
That conversation up next.
Ueda-san is an academic. He's not political. He's very pragmatic, and he says what he sees. When you look at the dollar yen reaction this morning, that to me was a classic example of people pulling materials of comments made by Ueda-san over the years. There were hawkish comments, there were dovish comments, and I think there was reactions either way to that.
Love Halfpenny. Maybe a little bit of confirmation bias there, depending on which headlines you want to choose. Japan Eiger, surprise candidate for BOJ governor. Bloomberg reporting, alongside many others, the Prime Minister is set to nominate Kazuo Ueda to lead the central bank. The decision blindsiding investors, expecting the deputy governor to take the helm and sparking a bit of volatility in the Japanese yen. Mike McKee, what do we need to know about this gentleman?
Well, you have to start with the fact that Kuroda-san, Haruhiko Kuroda, is leaving the Bank of Japan after 10 years. March 20th, his last day. And he put in place yield curve control and a whole lot else to try to keep interest rates low and push inflation up. Now, as you say, he is leaving. And for a long time, his deputy, Masayoshi Amamiya, was expected to be the replacement. And he apparently turned the job down. So the reporting from Tokyo is that Ueda-san is going to take the position. He's a former Bank of Japan governor, a board member himself. And then the question is, what are his policies going to be, specifically around this one, yield curve control? The Japanese have been doing yield curve control for years now. Kuroda put it in place, and basically they will spend anything necessary to keep the yield on the 10-year note in a low range. You can see the yield curve in Japan is kinked because of that. And there's a feeling that now with inflation double what the bank's target is, they could get rid of it. And so everybody is asking, what is Ueda going to do? Now, he has suggested that perhaps they need to think about, in the future, changing it. Current policy is appropriate, and monetary easing needs to be continued at this point, he says, but he suggested a policy review at some point in the future. So there's your both sidesism, John, that you were talking about. As I mentioned, a university professor, BOJ board member. He has a PhD from MIT, very well connected to the BOJ. So he is not expected to rock the boat. And as Derek Halpenny said, he is considered something of a centrist without a very strong viewpoint on what should be done. We should also mention that Shinichi Uchida and Ryozo Himino were expected to be his deputies. Both of them have supported yield curve control and have worked closely with Ueda-san in the past. So they may have a unified group going in. They just have to decide what they're unified to do.
Let's see if this gets confirmed first. Before March 10th as well, Mike,
yeah.
Because March 10th is the last Kuroda BOJ meeting.
The word is, at least it was yesterday, that the Prime Minister is going to submit the names next Tuesday, CPI day, because we don't have enough to do that day. And so
and assuming
we'll look for
he actually accepts this job, unlike the other individual. Mike McKee, thank you. Getting us up to speed on the BOJ. Important meeting March 10th. Let's see if we get that change from the BOJ on yield curve control. To Mike's point, equities right now, where are we? 23 minutes into the session, we are negative 0.2. On the Nasdaq, we're down about 0.6%. Your trading diary up next. 26 minutes into the session, no real drama. On the headline index, the S&P down about 0.2%. On the Nasdaq, down 0.6%. Heading towards still, though, a week of losses. That's the price action. Here's the trading diary. Coming up, UMich Consumer Sentiment Survey, top of the hour. President Biden speaks with Brazil's Lula at 3:30 Eastern. They'll have a meeting later. Plus, we'll hear from the Feds, Waller and Harker, throughout the afternoon. Looking ahead to next week, the only thing that matters, Tuesday morning, CPI on deck in the United States, and no doubt more Fed speak, including from Logan and Williams. From New York City, that does it for me. Enjoy the long weekend of the Super Bowl here stateside. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, February 10th. Here are the top market stories that we're following for you at this hour. BOJ shakeup. Kazuo Ueda could be the next Bank of Japan governor. The yen rallies like it's hawkish news. We're going to get the trade. And Russia risks re-emerge. Missile strikes and a deep cut in Russian oil output highlight the risks around the war. We're going to find out how much defense to play. And Eagles versus Chiefs and $16 billion. Sports betting could soar this weekend during the Super Bowl. We're going to talk to the CEO of FanDuel, who's hoping for some big profits. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And to top it all off, Guy, we get the UMich, which is one of my favorite indicators out there for a sign of what consumers are feeling.
And consumers are feeling better.
We are well off the lows, which we hit a while ago at 50. We continue to rise. We confound expectations, at least at a headline level. 66.4 is the number. That's up from 64.9. Current conditions, 72.6. Expectations 62.3. That's a little softer than anticipated. Inflation, though, one-year inflation now at 4.2. That's up from 3.9. The 5 to 10 number, 2.9. That is fairly stable. There is much more in this data series that is worth digging into. So let's start that process. Mike McKee, what do you make of these numbers?
Well, literally, he's just sitting down.
I've just said no.
We just made it.
I think it kind of follows with what we have seen. The economic news has been good. The job numbers have been good, so Americans are feeling better about current conditions. Remember, these are surveys of sentiment, and so people react to headlines, and the headlines have been about a stronger economy. But they also react to prices that they see, particularly gasoline prices. And I think that's why you saw the little jump here in the one-year inflation ahead numbers as gas prices have gone up some during the month of January. We'll probably get a confirmation of that on Tuesday when we get the CPI report. But people are basically saying we are more or less content with the way things are going. We have to point out that these are still depressed numbers. These are not an America that's jumping for joy, but at least it's a little bit better situation.
Nope, that's a good analysis. Mike, thanks a lot. Really appreciate it. Literally jumping in on the numbers. Mike McKee. Let's talk to the person now behind the data. Joanne Shu is the University of Michigan Surveys of Consumer Director. She joins us from Ann Arbor, Michigan. Joanne, talk to me about the current conditions versus expectation divide here.
Absolutely. So I would say that given how low, the record low that we saw last year, anything that's not a drop is relatively good news. So overall, the index just edged up a little bit, essentially unchanged. But what we saw was that current conditions have improved. Consumers feel a little bit better about their current situations. I think it's a continuation of the easing of inflation and some of the news in the economy that's making them feel a little bit better about the current situation.
Is this a trend you expect to continue? We are debating at the moment a great deal whether or not we're going to have a soft landing. The labour market continues to hold up. What do you think the trend here is? If you pull the data together in its totality, did the consumers get freaked out, have the fear about what was going to be happening with the labour market, saw the Fed raising rates, saw inflation and got spooked? Are we just kind of unwinding that?
It's possible, but I would say that in general, consumers are reacting to the reality around them and aren't necessarily reacting to Fed policy. So one thing that I think is really supporting consumer sentiment is the strong labor market as well as strong incomes. One of the reasons people felt better this month is that, they're reporting stronger incomes than they did in January. The thing to note, though, is that a lot of people are expecting the labor market to deteriorate in the year ahead. I believe it's about 40+% of consumers believe unemployment is going to worsen, and that's up from 25% a year ago.
I do want to get on that, Joanne, but I just wanted to articulate the chart that we were just looking at, U.S. investors jumping back into stocks. This kind of echoes a lot of the data that we've seen from like a JP Morgan. It says retail's coming back and trading like we haven't seen since the meme craze a couple years ago. Are you noticing a lot of that, and what does that tell us?
What we are seeing is that consumers that have the largest stock holdings had really large improvement in their sentiment over the last month. And given the rising asset values that has supported consumer sentiment, I do expect some consumers to be more interested and less hesitant about participating.
In terms of what people are seeing in the labour market, I just want to sort of dig into that because you have a whole load of kind of data on this. Unemployment over the next 12 months. In terms of where we sit with that right now, is that number moving significantly, Joanne? Where do we expect that number to be going given the strength in the labour market, the shockingly strong labour market that we currently have?
So I think consumers understand that we are at record lows for unemployment rates, and there's really nowhere to go but up. And the question is how much. So as long as consumers still believe that their incomes are going to remain strong, I think that will continue to lift consumer sentiment and their willingness to spend. But again, consumers are very much bracing for a downturn, bracing for more unemployment, and so they are going to be continuing to be cautious with their spending in spite of the fact of the easing inflation.
So I think that's a really really interesting point if we walk it forward, because if we don't get that huge downturn, and if the Fed's able to engineer some kind of soft landing, or the unemployment rate doesn't go to say 5 or 5.5%, is there any indication that all of a sudden consumers will be like, cool, let me spend it?
I think it's unlikely there is going to be any sort of sudden shift, because I think consumers are going to continue to be cautious until they really feel confident that we're out of the woods, particularly with respect to inflation. One thing I do want to point out is that in previous debt ceiling crises, consumer sentiment is tanked. It happened in 2011 and 2013. It's not really on the forefront of consumers' minds right now, but as negotiations escalate, I do expect that to weigh on consumers' anxiety over the economy.
Joanne, when you look back on that 50 number that we hit a few months back, do you think that was a real number? I'm trying to understand why consumer sentiment got so beaten up, or whether or not that was an aberration. The trend line obviously was falling fairly aggressively for quite some time. We were dealing with a number of different factors, including the pickup in inflation, which was suddenly taking off. I'm just wondering what your thoughts are on the correlation between that 50 number and the reality in the economy at that point.
That's a great question. So what I would say is that the fact that the level was 50 is less important than the fact that that looked like a trough. I mean, I do think that that was the bottom of how consumers were feeling about the economy, particularly because of inflation, as well as a lot of uncertainty. You know, around that time, there was so much uncertainty about how oil prices, gas prices were going to move. A lot of uncertainty of the impact of the Russia-Ukraine war on the global economy. There was just so much uncertainty and anxiety, and I think the fact that we hit that low reflects how consumers were feeling. Now, it doesn't reflect, the strength in the labor markets and so on. But I do think that, relative to the months before and the months after, consumers certainly felt much worse about the economy at that time.
Joanne, before we let you go, you mentioned the debt ceiling. Investors just do not seem to care about the debt ceiling, but you're saying that that's actually, you're seeing that come through in the data in some capacity?
We are not seeing it. We're seeing early signs of it, but not yet. Based on what we saw in 2011 and 2013, consumer sentiment really took a nosedive during those periods. So my expectation is that given further political polarization and continued sort of anxiety that we've been seeing over the last year, that if negotiations really escalate and there isn't a solution in place, consumers are going to fold that into their sentiment.
Interesting.
Another factor to fold in, as you say. Joanne, always a pleasure. Thank you so much, as ever, for joining us on such a critical day and providing us with all of your analysis. Joanne Shub, University of Michigan Surveys of Consumers Director. Okay, coming up, we're going to go back to the markets. US stocks under a little pressure today. We're seeing the Nasdaq 100 dropping to a session low right now. Those are the numbers on the screen in front of you. We're going to pose our question of the day. Is it time to bolster your defensive line? Super Bowl this weekend. Lisa Erickson, US Bank co-head of Public Markets Group, joining us next. This is Bloomberg.
complicity of the international finance institutions, including particularly Goldman Sachs, is there. Otherwise, one MDB wouldn't have happened. You can't just get away and by ignoring your moral responsibility. And I think Goldman Sachs should come out clean and deal with Malaysia.
We think this is going to be a tough environment for companies going forward. Costs are elevated, especially the cost of capital having risen a lot. That is yet to be absorbed. And top-line growth slowing meaningfully as consumers start to retrench. Companies have too much stuff. We think there's going to be a major war on margins in 2023.
That was Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management on corporate margin pressures, which brings us to the question of the day. Is it time to bolster your defensive line? I want to ask Lisa Erickson, U.S. Bank Senior Vice President and co-head of a public markets group. On the one hand, we see risks emerging still, whether it's Ukraine, whether it's Russian oil, whether it's the war on margins. But then you get this UMich data, comes in really strong, and now you have an S&P that's flipping into positive territory. How do you bolster your defensive line?
We do think it makes sense to bolster the defensive line. And while, again, we're getting some green shoots of upturn, again, even if you look at the UMich numbers, we've got an uptick, but really at still an absolutely low base. And that's repeated when we see economic indicators throughout a variety of sectors. Again, there are a couple that are starting to inch up, but overall economic activity is depressed. And then when you flip to the other side in terms of looking at inflation pressures, again, we've made some progress, but absolute levels are still relatively high. And so really for us, that points to, again, being relatively more cautious by underweighting U.S. equities, again, just because there's a potential really for that continued volatility in the market.
Can I just point out as well that Alex and the concept of a defensive line are not really that kind of solid. They don't really go hand in hand.
He's just making fun of the fact that I really don't know anything about football, is what's actually happening right now.
I think Alex is going to sleep through the Super Bowl this weekend.
100%.
I'm just going to point that out as well. Almost certainly. Lisa, are you surprised, therefore, by the rally that we've seen? You've seen some really beaten up stocks coming back very strongly. What do you make of that rally? Were you positioned for it?
The rally really is a reflection of sentiment on the back of the fact that folks are seeing that economic activity is decelerating and hoping that the Fed's going to be reactive. We have still been cautious nonetheless. If you listen to Fed comments both historically as well as even in the last few days, it's clear that the Fed really remains on a restrictive path and that they believe that job isn't done with respect to damping down those price pressures. And so with that kind of headwind in terms of monetary policy, in addition to the fact that restrictive policy really takes time to flow through to the economy, again, we just think that adds up to a more defensive posture.
It just feels like it's also really tricky, Lisa, because, the mentality still feels like buy the dip. It feels like the retail model is coming back to some extent. You've had a lot of short covering. So if you wait on the sidelines or you're too defensive, then you're just not going to have the same kind of performance. But then if you chase any kind of rally, then fundamentally that puts you in a tough spot. How do you handle that?
To your point, it really is difficult to navigate at some point the fact that sentiment will more durably shift simply because as the Fed loosens up and that presents the opportunity for risk on assets to do better, you have to balance that again against the current trajectory that fundamentals just aren't doing as well. And so really the way we're playing this is, again, being on the cautious side of it, but modestly cautious. So we would not advocate at this point, just throwing the baby out with the bathwater and being significantly underweight U.S. equities. But we do think, again, a more reduced position on stocks, as well as adding to areas that are more defensive but still can capture some earnings growth, such as global infrastructure, and also getting some of that nice interest rates that now we're seeing on fixed income can bolster returns.
What do you think of U.S. tech right now? It's come roaring back. Take a look at the Tesla share price, and it's been really quite amazing. We've seen a few bumps recently, but nevertheless, how do you position yourself in what has been, for the last decade, the darling of the stock market? Is that era going to continue? Should you still position towards tech, or do you think it's time to pivot away?
For investors with a longer-term time horizon, we really do see tech as an attractive sector. Again, there's secular tailwinds that continue to bolster potential for growth with specific industries and companies within that area, artificial intelligence, machine learning, on-demand, anywhere kind of shopping habits. And so all of that will continue to produce demand for those technology services. In the nearer term, however, so for clients who really are focused on specific objectives over a shorter term horizon, we do still see some volatility with technology. Certainly, again, with the Fed remaining on a more restrictive stance, that it just provides a tougher environment for these longer dated companies with longer dated earnings to do as well.
So Lisa, where else then do you like, if you're going to be modestly cautious, say on U.S. equities, where else do you go?
So really right now we're emphasizing putting some of that underweight in an area called global infrastructure. And what that area really represents are industries that are essential, again, to the infrastructure of the economy here in the States and elsewhere. And so this would include areas such as midstream energy, transports, communications, and utilities. And again, they provide a very nice yield right now, which can buffer some of that volatility in the equity market.
Is this to a certain extent also a play on the IRA, Lisa?
Well, certainly some of the companies in that sector certainly can pick up from the Inflation Reduction Act. And we have seen really some nice pickups since that legislation was moved through the legislative process in terms of, again, being able to benefit from moving in terms of improvements with climate change and also increasing focus on, again, ESG goals.
Lisa, great to catch up. Have a great weekend. Enjoy the game. Lisa Erickson of US Bank. Thank you very much indeed. Alex is going to sleep through it. I'm sure many of you won't be. Still ahead. Yeah, not kidding. Lyft shares sinking after forecasting lower profits, Alex. Apparently it's planning to cut prices to attract customers. Details next. The startup is coming up next. This is Bloomberg.
Great questions.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Bloomberg learned that Fox has turned down offers of more than $2 billion for its Tubi streaming service. That's more than 4 times what it paid for the business. The Fox CEO, Lachlan Murdoch, wants to keep it because of its fast growth. Tubi is a free ad-supported service, and it's free online TV that's bringing in the viewers these days. Apple is under less pressure than its tech peers to slash jobs during the current slowdown. That's because it hired more efficiently in the first place. During the industry's hiring binge, Apple added fewer employees than other big tech firms. On top of that, the company generated far more revenue per new hire than its peers. And shares of Adidas are falling today. The German sports shoemaker warned it could post an operating loss of as much as $750 million this year after terminating a lucrative branding agreement with the rapper Ye. That's a worst-case scenario if it has to write off all existing Yeezy shoe inventory. And that is your latest Business Flash. Alex.
All right, thanks so much, Ritika. It is 22 past 7 on the West Coast. Let's get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-anchor Ed Ludlow. Ed, Lyft down almost 34%. I mean, was the quarter that bad?
Yeah, by the way, if you carried on down the Embarcadero in that direction, you would get to Lyft's headquarters after about 2 miles. Literally in that direction. Lyft's going in the wrong direction. Let's get straight to the outlook. Fiscal first quarter EBITDA, the company saying it will be between $5 million and $15 million. The street was looking for around $84 million. That's pretty low and a pretty big gap, and it shows just where Lyft's at right now. You know, a picture tells 1,000 words, and this is kind of a profound moment. Reading across all of the reaction, this kind of is the confirmation that Lyft is falling behind Uber. Uber is taking market share, and Lyft is becoming an increasingly distant second player in the rideshare market.
Why? What is Lyft doing differently that Uber is able to take advantage of?
A mixture of factors. A lot of Lyft's business is out here on the West Coast, and a lot of the discussion on the call was like, well, cities on the West Coast were the slowest to rebound and the slowest to reopen. They also had to act to stay competitive, which was to their detriment. So what did they do? They cut prices to keep up with Uber. And, you know, I think that there's another chart that I want to show, which is just ridership, that it shows the story here for Lyft. That line is so important because for all they're trying to do and increasingly taking into account them falling behind Uber, they're still not back at pre-pandemic levels, whereas Uber is growing, you know, very high double digits in terms of its gross booking volumes, and also is able to bring more drivers onto the platform because it has a more diversified business, which makes it attractive to those drivers as well. So it's hard to know what's going to happen here, but, you know, Mandeep Singh of BI, others in the market have suggested, is someone going to come in and buy Lyft?
Well, that's what I was going to say. You got a lot of downgrades from lots of analysts on the news. It's an execution issue. It's a profit inflection issue. I mean, the rhetoric isn't really great. So what does Lyft do?
Well, we've been asking this question all week on Bloomberg Technology to sell-side analysts, to investors. Should Lyft expand its offering? Should it move into delivery? And the answer is no, absolutely not. It's too expensive, and it will make a cash flow situation that's already difficult and perilous even more difficult, and it's too expensive to pull off.
Ed, can I just go back to the question you just posed a moment?
Yeah.
Basically posing the question, what would give Lyft a lift? And that is somebody buying it. Who could that be? Who would be interested?
I've got no idea. I mean, this is the thing well, I guess if you're a potential acquirer, your ultimate goal is because you see a way of making money out of acquiring Lyft, or at least growing another part of your business. I don't see anywhere where there's some symbiosis, and, you know, without being too cheeky, I think Mandeep Singh of BI, who was on with John an hour ago, gave a similar answer. It's hard to see who the acquirer would be.
Yeah, I think that
Amazon? I have no idea.
Right. Uber, would Uber need something like this? Does Lyft have to get into different businesses like Uber did?
Well, I think the idea that we're hearing from the sell side is how would they do it? It's not something that happens overnight. It would be a very long road. I think Lyft's other disadvantage that everyone is pointing to is its geography. Uber is a global player where not just in ride sharing, but on its freight and other businesses, it operates in other jurisdictions. Lyft is much more limited to North America. So it's hit on both sides. It can't afford to grow or move into other areas because it will be a long road to get there, but it also just doesn't have a global footprint to leverage like Uber does. It's a distant second in a large US market.
Yeah. Ed, great stuff as ever. Thank you very much indeed. Have a great weekend. Have a great show a little bit later on. Bloomberg's Ed Ludlow. Coming up, a BOJ surprise. The Japanese Prime Minister's potential nominee for governor blindsiding investors. We're going to talk about the yen next. This is Bloomberg.
All right, we're about an hour into this trading session. It looks like a little bit of comeback here. The S&P now flatline, and Abigail Doodle is tracking those moves. Abby?
Yeah, Alex, in some ways it's almost like not much is happening on this Friday because we are looking at relatively small moves. But to your point, we are now looking at a gain for that S&P 500 up ever so slightly. Big tech down, though, still down 0.3%, being dragged on by the stocks. But very importantly, the stocks, that chip sector, a leading tel sector, it is holding support. Also to the upside, crude oil. Now, it's hard to know whether or not that's a good thing for stock markets or a bad thing. Traditionally, it would be a good thing. It's also a risk asset, but on the inflation watch, at certain levels, I would argue not at these levels, still below $80 a barrel. It's a good thing, actually, right now. As for the picture over the last several days, we are looking at something that we have not seen this year. We're looking at several down days in a row. For the NASDAQ 100, we are now looking at 5, I believe, of the last 6 days to the downside. At this point, down 3.6%. This is important because trend shifts can be very, very subtle. They start off very quietly like this, not without a lot of noise around them. However, if we put this little bit of a decline into the context of what's happening on the year relative to the S&P 500, we're going to see that the uptrend is actually intact. And the NASDAQ 100, in fact, all the indexes have a very similar trajectory. So this was the bear market of last year, but we've been flattening out ever since last October. Here is that near-term uptrend being held held by the S&P 500, a golden cross in play, telling you that the near-term buyers are getting a bit more excited. Yes, the 200-day moving average is slowing down, but the near-term buyers right now, it looks like they may bring the index up. And even a more immediate term uptrend, it too is holding. So the buyers are in control, but we are having a little bit of this battle in the near term over various factors. Now, oil, interestingly, not just on the day, but it's also up on the week, probably looking at a roughly 8% increase, the best increase of the year. In fact, one of the only increases. Actually, we had a nice increase earlier mid-month last year, so the best increase in about a month. But on the year, not until so long ago, we actually had oil down. So now we're seeing a little bit of a flip, not just for oil, but for the energy stocks as well, Alex.
All right, Abby, thanks a lot. Great setup. Really appreciate it. Let's stay on oil for a second. So Russia's planning to cut its output in retaliation against Western sanctions. What's the implication for that? Bloomberg's Natalia Knežević joins us now. Natalia?
So Russia is planning to cut about 500,000 barrels a day starting from next month. This is an equivalent of 5% of its January output. Russia's Deputy Prime Minister Alexander Novak has been very vocal, and he was saying that Russia will not sell crude to countries supporting price cap, and Russia will reduce production. So a chart behind me shows that Russian production, oil production is rising, but let's see what happens next. So we are already seeing an impact from price cap on revenue for Russia from its oil and gas exports. We know that revenue plunged 46% in January. So this, as well as an increased spending on military, so we have some numbers, it was a 55%, 59% increase for military. So a combination of those two factors gave Russia the biggest budget deficit for January since 1998. That's when we had Russia's default. And finally, the biggest question for the market right now, who will Russia cut more? Analysts I spoke with are saying that it depends on China, India, and Turkey. So these countries are three biggest buyers of Russian crude. So we know that flows to these three countries are rising, and of course, Russia also provides a big discount, and analysts again are saying that if this discount remains in place, these countries can benefit because some of them are processing Russian crude and then sell refined products to the European market.
Natalia, very nice. Thank you very much indeed for bringing us all those numbers. Alex, the question that I'm still trying to work out is whether or not these cuts that have come from Novak, come from Moscow, would have come anyway. OPEC is cutting capacity. Russia is part of OPEC Plus. Is this just a rebranding exercise?
Well, to that point, I also wonder if Russia oil industry is running into some constraints, because the sanctions definitely hurt in terms of, say, technology and stuff. Like, you need things to be able to produce oil, and I wonder if there's some constraints on that, because this didn't happen 2 months ago when the sanctions first took effect, right? Yep. It happens now. I also wonder if we're going to get a read-through to China demand potentially not being as strong as maybe OPEC Plus was thinking. And I say that because OPEC Plus isn't doing anything about this. So clearly there's some expectation that the market can handle it.
Yeah, which comes back to kind of where should we have been anticipating all of this? Certainly Moscow's been hinting at it. The signals and signs, as you say, coming out of OPEC maybe have suggested it as well. It's an interesting one. The market, I thought, reacted quite calmly this morning. We did see a little bit of a pop, but I think to many people's minds this was news that we probably should have been looking for at some point. And maybe the Zelensky move over the last 24 hours, 48 hours in Europe, the moves he's been making in terms of shoring up support, another reason for this news to come out at this point. The other bit of news we've had that I think really surprised a lot of people overnight, completely blindsided the market in so many ways, was the pick, Alex, for the next BOJ governor. Kazuo Ueda is a professor, former Bank of Japan board member, though, and will be nominated to take the helm at the central bank. The announcement marking, well, sparking to a certain extent, quite a decent-sized move in the yen earlier on. Are we going to continue to see that? Mark McCormick, Global Head of FX Strategy at TD Securities, joining us now to try and answer that question. Mark, the Ueda announcement clearly caught a lot of people by surprise. What does it tell us about the exit from the extraordinary policy that the BOJ has been pursuing? And does it tell us less about the sort of the move that is coming and more about the timing of that move? I'm just kind of wondering how we should interpret all of this.
Well, I think part of it is there's a huge surprise factor. This was he's on nobody's short list. So I think a part of it has to do with the policy trajectory based on the fundamentals. And those fundamentals are quite clear. One is inflation is quite strong in Japan. Across all the countries that we track, the trends in inflation are higher than any other country in the world. And if you kind of think about what's going on locally, if you look at the Tonkan report, there's significant price pressures and they're very broad-based. And that's hinting towards the Shinto wage negotiations are going to be quite high as well, which is basically a confirmation that the problem is solved and it's kind of move on with a new policy. The other side of it is the sustainability of maintaining yield curve control when rates want to continue to break out of the range that they're being kind of repressed into. So it's a self-defeating policy at this point because it's costing lots and lots of money. So I think the way that the market's interpreting this is kind of like now, regardless of who's there, we know the underlying conditions of what needs to happen next, and what needs to happen is the policy normalization needs to continue. Mm-hmm. I would lean in the camp that March is wide open because we got a surprise in December, and we can basically just recalibrate to new policy settings before the new governor takes over in April. So March to me is very live, and it's very bullish for the yen, the way the market might want to trade it.
Hey, Mark, I don't get then why dollar yen's trading at 131. I mean, we're off the lows. What gives?
Well, part of it too is, so there's a couple different factors that, like, there's the internal factor, there's the BOJ factor for the yen, which is quite important. We know that it's undervalued and it should be higher. And we also know that 10-year JGB rate should be higher as well. I think part of it has to do with kind of market positioning. One thing is we're kind of seeing this tension, and we hear a lot from client questions, is like our positioning models are still showing the dollar is very short. So there is scope here. The dollar's tried to build off of the NFP gains last week, and it's also, we don't know markets really understanding what the next move is. I'd say positioning's one side of it, but if you think about it, yen is basically trading in a 132 to 127 range. So the key factor for the next week, besides the nomination itself, is going to be the U.S. inflation report.
Mm-hmm.
Okay, we'll come to that in just a moment. I want to ask one more question on the BOJ story, if I could. Mark, does the BOJ, as it makes this pivot, need a weaker yen in order to provide cover for what they have to do elsewhere? And are they going to try and make that happen? And I'm wondering what a weaker yen looks like to the BOJ.
Yeah, I think at this point they don't need the weaker yen. It was there. I think if you think about what the framework was for last year, why they were reluctant to move while everyone else was moving, is they really couched it in terms of gross national income. They really focused on that. If you think about it, Japan is a massive importer of energy, along with the Eurozone and along with countries like Korea. So the terms of trade shock that happened last year, the BOJ took an approach that we're not looking at the output gap per, GDP. We're looking at it as a gross national income. And this is a massive income shock that they went through because the cost of energy and the cost of things they were importing went through the roof. So they wanted to stay on hold to provide a cushion in easing monetary policy and kind of, easing monetary conditions as a function of the energy shock. They just took a different approach than everyone else. Mm-hmm. And now that I feel like, again, they've got wages higher, that inflation itself is more sustainable now that negotiation wages should be higher in real terms. So with all that in mind, the fact that the yen is extremely undervalued, I think if it gets stronger from here, it doesn't really have a negative impact. It could also limit how much inflation can move, because you still need to anchor it on the upside as well, which is what they're going to try to do this year.
Hey, Mark, what is the knock-on effect, though, right now that we can look at in terms of the bond market? If repositioning happens, et cetera, we're looking forward to March, how does that affect bonds?
Yeah, definitely it has an impact on treasuries. So, JGBs go up, it's kind of taking everything else with it. It's kind of it's also a function if you think about how things were working in Germany with ECB. ECB is likely to be more hawkish than the Fed. So 10-year German bonds and JGBs are likely to be driving U.S. treasuries at this point. And also, again, if we do move to the side where the BOJ is reluctant to move, they have to continue to purchase more capital to basically maintain that peg, which means it has a knockoff effect on treasuries. So basically they're selling treasuries, and that would also have unintended consequences for the U.S. Treasury market if they tried to maintain yield curve control. So I think at the very least, like the path of least resistance here is definitely probably a steeper curve, at least in Japan, coming from the 10-year side.
Okay, let's talk about that CPI print next week. The anticipation is that we could see a pickup in inflation in the United States. Mark, to what extent is that already priced into the dollar? What would surprise?
Yeah, the surprise factors can be very big. Everyone should be focusing on the month-over-month core numbers. Market expectations for around 0.4. I think your playbook is anything above that is really going to scare the market. As I just mentioned a little bit ago, market is really short the dollar. So this is where the dollar gets a little bit of its mojo back for at least the very short term, kind of building on the recent correction. But that is the only outcome that is favorable for the dollar. If we get in line with expectations or below, we are back to risk on, back to extended dollar selling. And actually, I think that would be the move that really kind of encapsulates a big, big downturn in the dollar if we do get another kind of weak or in-line inflation number. Because it justifies what Powell's saying is that growth is good. We like growth. And growth coming back is okay if it doesn't provide an impulse to inflation. And if inflation's kind of doing its own thing now and it's moving lower and we see disinflation for the next couple of months and growth is coming back, that's actually the best environment you have for undervalued global equities relative to the U.S. and a weaker dollar. So that seems to be, soft landing in the U.S., plus disinflation would be very beneficial for the weak dollar narrative, which we think is going to start to take shape again after this recent correction.
Mark, how do you play it? What's the best cross to play with that?
As we just mentioned, you definitely want to be long yen on that. So if your inflation comes as expected, it's convergence of rates, Japan to rest of world. Other thing you'd want to think about as well, this is very bullish for emerging markets in terms of carry. So like Brazil, if you think about LATAM, if you think about Eastern Europe and some parts of Asia, India, Indonesia, Hungary, Brazil, Mexico, they're all carry currencies. They would all benefit from the disinflationary impulses and the shift towards EM exposure in general.
Mark, is a higher oil price positive for the dollar?
It depends. It's the way that the FX market is kind of trading current commodities. It's really about the relative shift. So as you mentioned in your last segment, oil energy prices are still way down. But what's interesting is that base metals are way up. That matters for FX because the countries that produce the base metals are outperforming the countries that produce energy. I think for the dollar in general, we would need to see a significant 20-30% jump in oil for it to have an impact, because then people are going to start worrying about inflation again, and then the Fed comes back in, and then we got higher rates volatility, and then we kind of move back into that pattern. So I think right now kind of the moves we've seen in oil isn't too dramatic because it's not leading to any kind of impulse that would push break-evens higher or change expectations around the Fed. So I'd say right now in terms of levels, we're at a comfortable zone. But if we do get a supply-induced or demand-induced significant rally in oil prices, it's going to create concerns for the stickiness of inflation in Q4, which is when we do see the dollar actually starting to stabilize and get a little bit stronger after a significant weakness in Q2 and Q3.
Hey, Mark, awesome stuff. Thanks for jumping on with us. Mark McCormack of TD Securities. Really appreciate it. Happy weekend. All right, coming up, JP Morgan expecting the ETF market to double in the next 5 years. We're going to have details on that in the ETF Friday. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. In Turkey, 3 survivors were pulled from the rubble today, more than 100 hours after they were trapped by killer earthquakes. Rescuers had worked for more than 3 straight days. Meanwhile, the death toll in Turkey and Syria has now climbed over 22,000. China is accusing the U.S. of exaggerating the dispute over a balloon shot down off the coast of South Carolina. The Biden administration says it was conducting surveillance and has offered evidence it says backs that up. Today, China's foreign ministry again said the balloon was for civilian use. And the UK avoided a recession last year by the narrowest of margins. Gross domestic product was unchanged in the fourth quarter following a revised 0.2% decline in the previous 3 months. The cost of living crisis and strikes hit the British economy in December. President Biden will host his Brazilian counterpart Luiz Inácio Lula da Silva at the White House today. It's a show of support for Brazilian democracy, which was shaken last month by a right-wing insurrection. The meeting comes just 6 weeks after Lula's inauguration. Lula's predecessor, Jair Bolsonaro, has still not conceded defeat. He's been vacationing in Florida since December. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, Ritika, thank you very much. There is roughly $7 trillion of assets in the U.S. ETF market right now. That's according to JP Morgan, and that number could double by 2028. I'm reading that right.
I think
Double
we're
by
just on the very beginning cusp of what could be substantial growth. So my views, 5 years from now, ETF industry more than doubles to 15 trillion. Okay. And I think 10 to 20% of that could be in active.
I had to double read it. Joining us now is ETF Friday, Bloomberg's Katie Greifeld. All right, Katie, what's going to get us there in such a short amount of time?
It's a short amount of time. So for context, his view is 15 trillion in 5 years. That's roughly the size of the U.S. mutual fund industry right now. So it's a big number, but still, it's reasonable. In terms of what's actually going to power us there, we've seen flows come into really all stripes of ETFs, but this is really a big call on actively managed funds. Right now, they make up, 5% of the $7 trillion in U.S. ETF assets right now. JP Morgan thinks that could be up to 20% in the next 5 years or so. And you can see that, again, in the flows. They make up for roughly about 20% of year-to-date ETF flows, even though, again, we are talking about such a small sliver of the market. So that dynamic could flip, and that could eventually power us to that big $15 trillion number.
Katie, you wrote a fantastic story on ETFs that track political portfolios. I genuinely laughed out loud when I read it. I couldn't believe that somebody had come up with this. It's so fantastic. Walk me through the story and the investment thesis behind it.
So with these funds, we might actually have an ETF for everything at this point. We had been watching for this launch for a while, ever since these were filed for. So we have the Unusual Whales Subversive Democratic ETF, and then on the flip side, we have the Unusual Whales Subversive Republican ETF. And basically, they scrape public disclosures of lawmakers and their spouses. We're talking, of course, Congress people. And current rules mean that they have to disclose any transactions valued at more than $1,000 within 45 days. So basically, these funds take those disclosures and make a portfolio out of this. They split it up by party, as you can see. And really, the methodology, the thinking behind this is that if members of Congress can trade, we might as well make ETFs that track this. It's been a big topic on Twitter. To see this actually come to the market is pretty astounding.
It is kind of amazing, and in many ways makes a lot of sense. We've also gotten a lot of stories this week about how retail traders are kind of back in the market. They're in the levels that we've seen during the meme craze, etc. Have you seen anything in terms of ETF trading that corroborates that?
So if you look at some of the leveraged ETFs, we know that those are very popular among retail investors, among individual traders. They've definitely seen an uptick in volume, in trading activity, particularly on the short side. You have an ETF, SQQQ, which tracks triple the inverse performance of the NASDAQ 100. I know, it's really a high-powered bet there. It's seen incredible flows. And then to bring it back to these ETFs that launched this week, these congressional trading ETFs, they've generated a lot of buzz on Twitter. Typically, these sort of value types ETFs, they don't see too much in the way of assets, but these could be a different story.
Thanks, Katie. Really nice. Bloomberg ETF IQ co-anchor Katie Greifeld. You can catch ETF IQ, of course, on Mondays, 1 p.m. New York time. This is Bloomberg. Okay, European stocks are trading on good volume and they are down. This is the biggest move down we've had in 3 weeks, which tells you a lot because it's only 1.2%. The advanced decline is also fairly negative as well, well to the decline side in terms of the breadth that we're seeing in this market right now. What is performing? What is underperforming? Energy is performing. In fact, energy is the best performing sector this week and it is the best performing sector this session, and the reason for it is you've got Brent crude up by nearly 2% right now. Part of that's to do with what is happening with Russia, certainly a significant factor. So that's what's driving the energy story, but you've also had some really cracking results out this week. BP is now trading north of 100 billion in terms of its market valuation. That's the first time it's done that in 3 years. So decent week for the energy sector. Adidas is definitely not having a good day. Adidas down by 12%, let's call it. This is about the inventory it now has sitting on its balance sheet from the Yeezy debacle. We'll dig into the details of this in the next hour. Also in the next hour, we're going to be speaking to Dominic Johnson. He is the UK Minister for Investment. Looking forward to this conversation. There has been a global investment summit today in the UK. It's interesting in the light of the comments we got from AstraZeneca yesterday. Again, the Minister will join us next. This is Bloomberg.